Hey everybody, Mike Johnson with the Success Estate Podcast. Thank you so much for tuning into this video. This is episode 4 of season number 4. If you hadn't had an opportunity, go back and see the other 3 episodes, as there's a lot of great information, starting with the catch-up video of everything that's been going on in episode 1. Episode 2, I have my good friend Mark Robinson come on and talk to us about his role at SWEPCO and how he could actually help us save a few dollars on our electric bill. And then also I have Miss Kristen Ishihara coming on the episode number 3, and she helps us to start planning on how to get our estate in order with some estate planning. With no further ado, though, I'd like to reintroduce a great friend of mine, Mr. John Nustad, City Council member of District Number 4 here in Longview. We're going to jump right into our conversation.
Well, one of the main components that is going to be pretty much consistent throughout all of them is going to be the fact that you're an advocate for your constituents, right? And that's your job, is to help and address those concerns, issues, dreams, whatever that may be. You're that advocate of that person. And like last time I was on here, like I kind of explained to you, the loan officer role is the exact same thing as a city councilman to an extent. So like I'm tailor-made. Okay. I'm tailor-made for that, because what you have is, okay, I have a borrower, right? That somebody's coming to me and they're saying, hey, this is my problem. Here's what I want. Here's my goal. Here's whatever that is, right? And I take that information and I'm like, okay, well, I'm going to be your guide through that process. We have to work through guidelines. Mm-hmm. We have to meet the guidelines of the investor, right? Which is your policies and stuff like that. So we have to work through those channels. We got to get the underwriter on board, which would be consensus building. So getting the other city council, mayor, city manager, whatever that may be. We get those other consensus part. Yeah. And it may be just other private individuals, whatever that may be. Right. But we have to get consensus building. We can't just say, I'm going to do it how I want to do it. Yeah. So you do the consensus building. Then once you have that, then it's approved and it becomes, something that you do. So the goal and the role of a mortgage loan originator is very much like a city councilman in that age. Now there's other different things, like we got to approve budgets and we got to some different things. Sure. But for the most part, that to me is what most people think of as the role of a city council. Sure. Council man.
Did you know that going in, or did
you
have that understanding?
Yeah, I had that understanding before I went in. Yeah, so I mean, you kind of see it now. Part of it, you first kind of start off as it's kind of like a board position in a sense. Like it's like you're part of a board and you're doing those kind of different things, but it's much more involved in that. Like it's not just the work at the council meetings, right? It's work at all time. Like it's different things and different issues going on, or whatever that needs to be addressed, or just creating some clarity, whatever it may be. There's a difference each time.
Yeah. Probably one of the big questions probably recently start popping up is are we going to be getting the Buc-ee's here? You approve a lot of things. You help to approve a lot of things, and I'm sure you would have a clearer understanding even if you don't know.
We would only know to the extent of what's been pulled for permitting and stuff like that. Yeah. I mean, now if there's a planning and zoning thing that has to come up from that, there may be ways to know that way. Or if it's a lead co then there's ways that way. But other than that, beyond that, there's no other knowing. Gotcha. Besides that, but as it appears as it right now, that it is not coming to where the proposed location was.
I heard. I think it was a pretty funny but dirty trick. For one, I'm a avid Buc-ee's. If I'm driving by a Buc-ee's, I need to stop. So I saw it. Then there was a level of skepticism, because I was like, why would Buc-ee's put one in the middle of town? Yeah. You don't see that anywhere. It's on the interstate.
Well, apparently this was just based on all the whole conversation and comments and stuff like that, there's apparently smaller versions of them that are more, that are in inner city kind of deal. What? Yeah. Now, would they put that in a Longview area? I don't know. Especially, they would want a very high trafficked area.
Sure.
which Judson, on Judson where that one's at is high traffic, but it's not right on the loop, right?
Right.
The busiest intersection in Longview is at 4th Street in the loop.
Yeah.
That's the busiest intersection in Longview. So that's kind of where like it just doesn't make sense to kind of be further down for a Buc-ee's standpoint. So.
I mean, it is a big area over there. So, and speaking of like zoning and things like that, it feels like we've been getting a lot of zoning changes around here. Like it feels like there's been a lot of, I know. So my understanding is that it goes to planning and zoning. Like if there's a proposal, it comes before planning and zoning first. They have to approve it, and then the city council votes on that to approve those plans as well. Is that correct? Is that have you been seeing, in your time? I know your tenure has been what are you on, like month number 4?
6, something like that. Yeah.
Okay.
Now, as far as my knowledge on planning and zoning is, historically, I would have an idea of that. I know the last planning and zoning one we had, it was very short. We had 2 that was on a consent agenda, and then 1 was just for a drive-through.
Yeah.
So very, very quick meeting. It was done in 5 minutes, right? Now, it ebbs and flows. I don't think it's a pattern. I don't think it's or indicating of anything different, because before that has been pretty busy. We got a lot of big projects coming in, but it's only if you need a planning and zoning change.
Sure.
And there's different things that the city planner does on that to help make sure that it's meeting the comprehensive plan and what future use land map and what we want to use it for, and also that it's not spot zoning, that we're not making kind of exceptions to the rules, and it's kind of fits within that parameter. So there's different things that they look at before the city planner makes a recommendation.
In the comprehensive plan, is there something that you're looking forward to, like to see kind of come to fruition?
Yeah.
Is there something in particular that you?
So there's nothing in particular for me. There's things that as me as a person would probably want to see, but my job is to carry out the wishes of the constituents. So we just closed out the comprehensive plan survey, so we're doing a revision on that, since it's been, I think, 5 years since the last one's done. So we're actually doing an update. We're going to be updating the comprehensive plan based on some feedback that we've gotten through putting that survey out there to the public to complete, and what'll be on there, and what people are wanting. But it's been very beneficial the last, when we did the comprehensive plan, a lot of the connected trails and other other popular things that people have came from that. Yeah. And but no,
that's overall, what I mean, and I guess that's what my question spurred from, because I greatly appreciate the trail, because I live not far from it. We get on it, we can walk it, we can go different directions and all those different things, and end up, it feels like you can go just about all the way around the city and end up, back where you started from, or pretty close to it. But I didn't know if there, I may not have a clear understanding on what the comprehensive plan is. It seems, I don't know if the plan is like how far down in the future the plan is looking, is it just like 5 years? Like I said, I heard you say
it's going to be somewhere in that mid range area. I mean, there's some longer looking at it as far as like the future land use map, right? Sure. Like, because if you put buildings up or you put whatever development there, like you can't just reverse that, right? Sure. Like, so those will be more for long-term looking, and how we want the city to develop, and any of that infrastructure stuff would be more long-term. Now, the other stuff that's more, could be more midterm, more mid-time, like pickleball courts, right? That's something that would be more like.
Do you play pickleball?
I do not. I bought pickleball paddles or rackets, paddles, I guess they call them. Yeah. I bought them. I just have not been out because it was too hot.
Yeah, for real. So I actually just saw over here at Guthrie. I actually saw my 8th grade teacher, and he told us, man, I keep saying I'm gonna get out there and play pickleball. Because I'm hearing that it's really competitive too, and part of me kind of misses the competition a little bit, So I'm looking forward to it. I don't know where future pickleball courts may be, but I like it right here because it's right down the street from me.
Yeah, and we're expanding the parking there. So
that's right.
So we're gonna improve.
Oh man, it needs it.
Yeah, badly. It's gonna improve it and add more parking spaces for it. Awesome. So that's coming. That's gonna be coming pretty soon.
Okay, that's something to be excited. I'm excited about that. Everybody else might not be, but as me and Alicia, I at one point I told her, hey, let's pick up tennis, to get exercise in and things like that. But pickleball may be
Yeah, I've never played. So I'm a racquetball player.
Got you.
And I say that I was a racquetball player.
I was saying, where do they play racquetball around here?
So
Laterno?
Parkway and Courthouse.
Yeah.
Or the two, or now it's Stafford Fitness.
Yeah.
Okay.
I didn't know they had.
But it's not Parkway anymore. It's something else.
Yeah.
Drawing a blank. The church bought it, but.
Yeah, Life Point.
Yeah. So those names have changed since then, but so I first started playing racquetball when I was middle schooler.
Oh wow.
And I played at the courthouse.
Yeah.
And my uncle taught me, and so that's how we learned. And so my brother and I would play all the time, and we were just playing for fun. Like it wasn't serious. And then when I got into college and I started going to UTA, I played racquetball every day, 2 hours a day, Monday through Thursday.
Man, don't you miss
played all the time. I did. So I got off work. I got there about 6 o'clock and played till 11. I'd lift weights too, but I'd play racquetball and then work out.
Yeah.
And so I did that. Got to be a pretty good racquetball player and enjoyed it. And then we moved off, and so I played. I didn't play. I played in Indiana a little bit.
Oh yeah, Indiana, that's right.
And then Ann Arbor, though, I don't think I played at all. I'm trying to think if I played up there. Indiana had a good scene, a good racquetball scene. And then Ann Arbor, I don't think so much. And then I moved back down to Bossier. I don't know if I played there, but then when I got back to Longview, I started playing again. And then I played in a few tournaments here and did some different stuff. But it's fun. I love racket sports. So I think I would like pickleball.
Pickleball, yeah. I've never done any of it, so I'm probably gonna be terrible. But like I said,
you have hand-eye coordination though.
Yeah, well, I'm hearing that it's more difficult than that, understanding the spin of the ball and different things like. But all that kind of excites me, it's learning something new, which is kind of what I love about this business, is that I'm just constantly learning something new. It's almost intimidating to call you sometimes because I feel you're gonna tell me something that I've never known, but I feel like I should have known, And I'm not, and it's not. I mean, not like in a way of like I'm scared, but it's almost like, man, what's he gonna tell me today? Because you were the first person to like VA doesn't have a minimum credit score. Right. And I'm like, I've been doing this. This was at our earlier podcast. I was like, I've been doing this 5 years. How do I not know that? Yeah. And
most lenders add an overlay.
Sure.
I mean, that's just they're going to put an overlay, an additional rule overlays, additional rule above the guidelines. Sure. And so that's why you don't. I mean, for the most part, like if you're going to be below 540. I mean, you're probably. VA's probably not going to accept it. Yeah. But they just don't have that standard rule.
Gotcha.
And then, it's always learning.
Sure.
And it's like I think it would be nice if we got into the point of where we started saying that we practice real estate or practice, because we're always.
That makes sense. Because I will adopt that right now. I practice real estate. Because that makes sense.
It's always changing.
Sure.
The cycle that we're in, the environment that we're in.
Yeah.
If you're not fully submerged in it, if you're out for 6 months, then you're
getting left behind.
You're gonna be left behind. Yeah.
Speaking of, 6 months, changing all these different things. Since our last podcast, things have changed on the real estate scene. Could you talk a little bit about some of the changes that you're seeing on the lending side? Some of the things, how the summer transpired for you. Now we're rolling into fall. What are you seeing right now?
Yeah, so rates are higher than they were even in the peak in October. So, which is surprising with inflation coming down. I was not expecting that. Mm-hmm. When rates started turning down last time, we thought that was going to be the end, but rates have went back up. There's a numerous of different economic factors for that, and where we're going to go. I mean, no one knows, right?
Sure, right.
But long term, the interest rates are most correlated with inflation. Okay. And the more short, medium term, they're more correlated with your 10-year treasury on mortgage rates. And so eventually the rates are going to come down. Yeah. Like they're going to follow inflation. Inflation's already in the 3s at this point. So it's going to come down.
Yeah.
Now, what the market does is they're always like, the market looks forward about 6 months. Mm-hmm. Okay. So they're always trying to predict out 6 months. And that's why you can have rates go up even though the indicators are going down. Because now, with the latest economic data, they're looking at the Fed's actually going to make an announcement today, I think at 1 Eastern, that are they going to raise rates or are they going to pause? The expectation is today that they're going to pause rates. Now, but there's 50-50 chance in November they're going to raise rates. So that's why the market's pricing up the rates higher right now, in the most part. Now, Powell or the Fed, like they're going to kind of always leave things on the table. Like they're going to say they're going to look at the data, all this stuff. And part of me believes that they're not being fully truthful. So at first, whenever let's say even end of last year to maybe even early this year, I thought we get inflation between 1% to 3%, that we're going to see the Fed just pause and hold steady.
Yeah.
And I thought and that's what they've been telling us. What I really think is going to happen now, though, is I think the Fed wants rates to go, like they want to create a recession. Like they want to pivot faster.
This is a pretty big statement you're making.
So my thought was like we get 1% to 3% inflation. They'll hold it steady. We'll kind of have a soft landing. We'll try to prevent a recession, and we'll go that way. But the more, because we're further along in this cycle than everybody imagined. Like me included, and the Fed included, thought it was transitory, which means that the inflation is going to quickly go away. We can it was due to Fed stimulus and other different things that were going on, that this would quickly resolve. Well, come to find out, it was not transitory, and we've been in this longer. And what you got to understand is the Fed cannot leave rates up here. So if we're hitting 1% to 3% inflation rate, we cannot stay here because several different reasons. For one, the government can't afford their debt.
All right.
So it's a common term. It's called refinancing their bonds, right? But it's not really refinancing. What happens is bonds expire, and then they issue a new bond to replace it, right? And so if your bonds are expiring and they're at the 4% range or whatever they're at, or 3%, whatever they're at, now the new bonds, they have to issue a new 10-year bond at 4.3%. Right now, like interest is already our second biggest expense behind defense. Right?
Wow.
So they can't afford higher rates. The government has to, because they're not going to stop their spending. So only thing they can do
is increase the rate.
Is to drop the rate, right? They got to get they got to get a lower rate. So that's one thing that we have to be very so if we stay where we are, we can't. The government can't afford it. The other part that you have too, and it's in the commercial industry. In the commercial industry, they do adjustable rate mortgages.
Right.
Okay. Now, in the housing, they do fixed, a lot of times because we have a secondary market we sell to. But in the commercial business, they typically do 5-year ARMs. Okay. And what that means is after 5 years, the rate will adjust based on whatever benchmark and plus whatever margin that they have. Well, if you bought a property and you bought it at a 4% rate, and now you have to refinance it at an 8% rate, you can't do that. The commercial market would collapse. And so like right now, if you look at all the different indexes in the market or different sectors in the market, REITs have they're a big lagger because of that reason.
REITs,
real estate investment trust.
Gotcha.
So that's your big commercial space, right? That's where the commercial industry cannot have rates up here without creating some sort of big devastation in the market. Once we start hitting that, once we have to get rates down before that 5-year mark, before these adjustable rate mortgages start.
Because I've listened to several people say that the bubble is actually on the commercial side of real estate.
Commercial, the bubble would be more there than they would be in residential, because commercial is very much dictated by cash flow, right?
Okay.
So cash flow is what dictates a property.
Gotcha.
So to a large degree, but it's like cap rate, right?
Mm-hmm.
So,
Okay.
but your cash flow makes a big difference. So if you're cash flowing on that property and you bought it and you're cash flowing at a 4% rate, great.
Yeah.
Doesn't mean you're probably not cash flowing at an 8% rate.
Right.
And so then what happens is it dries up the market. And so, I mean, the banks have already tightened drastically. And so, yeah, commercial space is where they would get hit the most. Office space being the biggest potential issue because it's facing the issue with the rising rates.
Mm-hmm.
And they're going to have a hard time renewing those same lease agreements because rent went up, right?
Sure.
But rent's on its way down. So,
Okay.
but then office space has a problem with higher rates, has a problem with decreasing rents, but then also the other aspect of it is that remote work.
Yeah, I was about to say decreasing usage at the same time.
Decreasing, yep.
Right?
So they're in the biggest, they're in the greatest storm right now.
And didn't you used to do some commercial lending as well?
Yeah, I did commercial lending for 3 years.
Yeah. Are you concerned? What's your level of concern?
I'm not concerned at this point.
Not concerned.
No.
Okay.
The banks are well capitalized. In 08, 09, the real estate industry and the banking industry caused the issue.
Yeah.
I mean, this time it's not caused by them. The banks are well capitalized. There's some issues there because we've had more bank failures than we had even in 08, 09.
Sure.
So we've already had that. Now, those really have to do with when rates going up like that. A lot of them hold treasury, and the value of the treasury.
Okay.
So when yields go up, the prices go down. Okay. So let's just say you have 100. Let's say par is at $100 and it's at 1%. Okay. If the par price, the price of the bond goes down to 90, well, the rate goes up because now if you buy it at $90, the same rate's still the same, but the interest coupon is still the same, but the yield is different, right?
Seesaw effect.
Yeah, so it's a seesaw on that, right? So what happened was they bought these treasury bonds. Well, with rates going up, that means bond prices are going down. Okay. Well, when you have a run on the bank, like we had, because of the failures of whatever now they need liquidity. What they have to do, they have to sell these bonds at a loss.
Oh, Lord.
So they have the money to give out to the people for that. So the Fed they made some steps to help with the liquidity issue, but the Fed should have already had something in place to where the banks were not having to sell their bonds at a loss to provide liquidity.
I think in one of speaking of the Fed, I think in one of we're going to review some TikToks today and respond to them. And I think in one of them, they were mentioning something about the Fed hindsight, and this is a hindsight 2020 kind of thing. And I'm not disparaging the Fed because I tell everybody, I think we made the best decisions that we thought we could make at the time. Mm-hmm. There was who knew what 2023, the end of 2023 was going to look like. As a matter of fact, people, are making all these different kind of predictions for what this part of the year was going to look like, and a lot of them have been inaccurate. Do you think that it was good for the rates to be where they were in 2020, 2021, as low as they were? And do you feel like the Fed responded to kind of the crazy situation of home buying? Do you feel like they reacted too late to that?
I think the decision was correct. The initial decision of it, it's Keynesian economics is what that is, right? So in a time of tightening, it's the government's job to spend, right? Because everybody else can't.
Oh, okay, gotcha.
So the way to spur that deal is Keynesian economics. And so we saw that first time really played out in 08, 09 with Bernanke. They did the bailout of the banks.
Yeah. Right,
and they did these different things. So we saw that. Now, in Bernanke's time, they reacted a little bit too late, right? And it caused too much distress in the real estate market.
Gotcha.
So you kind of learn from that, right? So this time we were much quicker to respond. Like the Fed was
Too quick?
The Fed was not too quick. The Fed was very quick and they responded very fast, very quick, in the right way.
Mm-hmm.
The PPP program,
Yeah,
the Paycheck
yeah.
Protection Program, was a great program. It wasn't rolled out very great, but as far as what it did,
Yeah.
I mean, it saved countless business and countless nonprofits.
Yeah.
With that. Then you had the COVID stimulus money and all that stuff that kind of put out. Still, again, great decisions. And overall, like when I made the decision, when I came over from commercial, I actually went over from commercial to residential in April of 2020.
Oh, wow.
Because
Oh,
I knew commercial was going to dry up.
Yeah.
And I knew residential was going to boom because I knew the playbook.
Yeah.
I knew that the Fed was going to step in. They're going to drive down interest rates, so that way it would spur that. And with the housing market makes up 20% of the GDP.
Yeah. So
and then
if you're causing people to,
and so you needed that to keep the economy
Gotcha.
humming.
Gotcha.
And then you're giving, and also in the case too, like let's say unemployment, I knew was going to probably hit about 20%, right? So let's just say worst case scenario, unemployment is going to hit 20%. That means 80% of people, and even those businesses that got the PPP and stuff like that, because they didn't have all the other expenses, 80% of the population is going to be wealthier coming out of COVID than going into it. And honestly, the percentage is much higher than that. Like so then what happens too is, okay, so let's say 80% of people kept their jobs, right? 80% of people kept getting their same paycheck.
Right.
Then you add in interest rates dropping, which cause their ability to lower their expenses on their housing. They're able to lower their expenses on whatever debt they have, right?
Yeah.
They're able to do all that. Then you have the COVID stimulus money on top of that, where now they have more. Now they have actually money to go spend. Everybody came out wealthier in the end.
Right.
Now, do I think we did it too long and we did too much? Yes.
Yeah.
Like the last whatever stimulus that they did, what they call it, the Inflation Reduction Act. And,
and
those other measures that they did, which just further put money that was way too much into that where we should have stopped. I mean, we got too much where anytime you also have like a sugar high like that, the bigger the sugar high, the bigger the crash, right? And that's why we're seeing now the market and the real estate side now, because you have it. So I don't want you to hear crash and think that the housing market's going to crash.
No, I know what you're saying.
Demand crashes.
Yeah.
Now, in the same sense, we've had supply crash just the same way.
Yeah.
So therefore, we're not having the prices crash, but we're at 26-year low mortgage applications right now.
Yeah, right.
So demand is at an anemic level.
Sure.
That has crashed. Supply has crashed though evenly as well.
And that feels like those are the factors that the Fed really couldn't see from a distance. I feel like they tried to quell the demand because the demand rose so greatly.
Yeah.
And at the same time, of course, we couldn't have that much supply because people just couldn't move. They couldn't do anything. And then when they go to fight the inflation using the real estate industry, they didn't account for, at the same time that we're trying to get the demand to dry up some, the supply is going to continue to dwindle with it. So now, and I'm very basic in my economics. So
basic is what you need to do.
At the same, it's like, okay, well then even though you are making a difference, you're making a slow difference. That inflation is coming down much more slowly because what we experienced over the last 5 or 6 months. I think our interview was like at the end of last year.
Yeah.
And what we've interviewed since,
it would have been beginning of this year.
Yeah, the beginning. That's right.
Because I was already.
That's right.
Announced I was going to run.
So what we've experienced is just a continued. Well, so home sales have gone down, but values have stayed high because there's still more buyers than sellers out there.
Correct.
And I don't see how that is going to change. Now, I will be the first to admit, because we're going to talk a little bit about some people that got predictions wrong. And I'm going to admit that I got a prediction wrong.
Okay.
Because my prediction was that by this time in the year that we were, and I've told several people this, I thought that we would start seeing interest rates drop. That's why your comment initially when you were saying, well, maybe they're wanting us to go into a recession, is kind of interesting, because I really thought, I said, okay, if I look at all these things, if the inflation continues to do what it does, what we're doing, we got home sales coming down. That means people aren't, buying as much. Our inventory is still low. It's actually grown a little bit though. So we've got more inventory than we've had in a while. Not by a whole bunch.
We're still below healthy.
Yeah, we're still below healthy. I think. Let's see. This is the quarter for August.
Yeah, we're at 3.5 months. 4 months is considered healthy.
Yeah. So that's we still need more, but year over year we're up 1 whole point. So we're getting more homes. We're getting less sales. Prices are starting to adjust in the market accordingly. Not accordingly, but according to what we have. Home values are still up, and people are still out here buying houses. Mm-hmm. Maybe not at the same pace, but they're still out here buying houses. And so with all that, I thought that this would kind of happen, but I thought we would start to see the rates drop with that. So your comment about them, like, hey, maybe we need a recession. Do you feel like they're saying that we need a recession?
I think they want to pivot faster.
That's scary too, though.
Yeah.
So we just experienced. Okay, we shot through the roof in sales and value and prices. When it was just hard to come down. Do you want to do? To me that feels like we're about to do an overcorrect.
That's notorious for the Fed. I mean, they always overshoot or undershoot.
Really?
Yeah, it's because they're using trailing data.
Okay.
And they're using data also that is not entirely fully accurate. It's the best that you can do. But they're using trailing data. So the reason originally why I thought, okay, if we hit 3%, our target 1 to 3% inflation, the Fed was going to pause and they're going to say we're hitting we're where we need to be. Well, if you looked at the last inflation data, now the only thing that was causing inflation to be higher than the target, it was the fact of new and existing leases. So rent, right? So new and existing rent. Now, what it does is it looks at both, and so most leases are 12 months, right? Mm-hmm. So what happens is in this data, if you look at that, you have 12 months of rents in there,
right,
which causes, we knew what they was. So you still have all this old data in there, but if you backed out the existing leases and you only looked at the new leases based on the data from Zillow and his other ones, we were at 0% inflation in rents. So if you back that out, our inflation was actually at 0% almost. So we were within the Fed's target. Now, if you're using,
so why wouldn't they respond to that? Is that what you're saying? Is that why you?
So that's why I thought they'd be like, because to me that makes sense. Historically, yeah, if we take that data out, we look at the new leases being signed, we can see that inflation is gone, as far as that goes. Now, what's happened since then is, you have core CPI and then you have your regular, right? Core backs out energy and I think housing, right? But the gas prices are up.
Oh yeah.
And so that's what. So if you back out energy, though, we were pretty good shape on the inflation data.
And kind of going along with that, y'all, we're going to do something a little different. We're going to do a few reactions, and I'd like to get your thoughts on this because I think it would tie into what we were just talking about, as far as maybe this is a reason why the feds have not brought the rates down.
If they drop the interest rates to 4% next year, we would have an absolute shit show on our hands. it would be a feeding frenzy and it would destroy the entire market forever. If you buy a house today for $400,000 at 7.5%, the payment with taxes and everything is about $3,500. In order to qualify for a $3,500 payment, you got to make about $110,000 with no debt to have a shot at qualifying for this. So how many Americans can actually qualify? A very small percentage, which is sad, but they had to raise the rates to stop the bleeding because the housing prices were just not going to stop. But if they drop it to 4%, overnight or even next year, not gradually, just quickly, that's going to be a recipe for disaster because the payment will drop to $2,500, which on paper sounds amazing. More people can afford it. You can now qualify with $80,000 if you have no debt. That's going to open the door to many more Americans, but that's going to increase the demand. The investors are going to come back and it's going to shoot the housing prices through the roof so high that it would destroy everything because it would also shoot the rent prices high. And people are already spending 40-50% of their income on rent. So we cannot lower the interest rates to the general public to 4%. If they ever were to lower the interest rates, I think they're going to go to 8, 8.5, even 9, I've heard. But if they do start lowering these into the 6s, they have to do it so carefully and so gradually so that we don't have an absolute circus on our hands.
So because I think I heard Barbara Cochran. Is that the Shark Show?
Shark Tank.
Shark Tank.
Yeah.
She said something very similar as well, and I could see that. Maybe. Do you feel like maybe that could be a factor in why it's like, oh, hey, we need to, instead of coming down because people are still itching to buy a house. I got several people that I know, just my clients that would be itching to buy a house if it become more affordable for them. Do you think that may cause a? What's your opinion on that, and on the video in itself as well, if you have any thoughts on it?
So I think we're at, first of all, in the video, I think we're at the highest rates are going to go. Like I don't see rates going higher.
9%.
No,
that's sheesh.
We're not. I don't see that happening. Now, we'll probably float around in that 7 to 8%. Mm-hmm. I don't think we'll ever go above 8. As far as an average rate. Yeah. But you don't want shocks to the system like that. You want things to be gradual. Sure. Because then people can change. Now, would it blow up the housing market? No. And
you don't feel like those prices, we would be right back where we were?
The home values will go up, and that'll home values go up, and that'll eventually offset demand at that point. So if rates go down, more people are buying, which causes prices to go up, and eventually you're buying, you're spending more money because even though you have a lower rate. Yeah. So we're always going to have bubbles are created by liquidity. Mm-hmm. Bubbles are created by that. So do I think it would shock the market? No, because of a couple different things. One is we would probably see like another milder 2021 type of environment. Mm-hmm. But you're not getting, the COVID stimulus was a big part of that. People got a lot of money on their income tax because of the credits. They got the stimulus money for that. So they actually had money to put down. Mm-hmm. Where most people, the biggest hindrance to buying a house right now is having the cash to close.
Oh yeah.
Because what's not mentioned in that is $400,000 house, $400,000, and he's using that. The median is like $389 or something like that.
Right.
So he's not far off on what that would be. So then, if you want a 5% down payment of $400,000, it's even more than it was when the median home price was around 270 or 280, whatever it was. Yeah. So the cash to close gets harder. And that's where the biggest hindrance is. Like the way you can look at it is like automobiles. Like automobile prices are crazy, right? And it's because they started doing longer loan terms. And so it caused the payments to come down. Yeah. Well, people buy more expensive car because of that reason.
They stretch it out. Yeah.
And they stretch it out. But eventually, now you can't buy a car that's affordable. And then it causes demand to go down.
Wow.
So that's
an economic lesson, because I didn't even think about it. I was glad when they told me, "Hey, we can actually stretch this out to 5 years." 5 years. I was like, "Oh, really? Give me that. Sign me up."
And the other thing too, coming out of it too, is you had people buying homes because home prices went up so much, they sold their house and now they have a lot of money to put in.
Mm-hmm.
And so the average loan to value right now is at about 43%, which is historically low. So most people have a lot of equity in their homes.
It is amazing how many, like, so around here, you know, if you can get a home at $200,000, you know, a decent home, it's really sought after. I mean, because I've competed with several cash buyers that are still out there with $200,000 of cash. I thought that was, you know, just a blip. We would have that for a couple of years and then that would be all gone, you know. And these people that I could think of, they were $12,000 over the asking price.
Yeah.
You know, and somebody came in with cash, and I was like, people still are buying houses with cash like that? I mean, the last three that were around 200,000 cash purchases.
Yeah, it's geohacking. So
Gotcha.
What they're doing.
Yep. Yeah.
Like I have one right now is buying a house. They sold their house in California. They're moving here, and they're getting some financing because they need another house to sell first. But they'd be a cash buyer normally, but they're able to move from California and move here and live much more cheaply. And so it's just geohacking. I have another one that's coming from Nebraska and another one coming from some other place. So one from Houston. So I have a lot of people relocating because Longview market, this East Texas market, is still much lower than, like I said, like the median home price is what, $380 or something like that, $389.
Yeah,
well, almost $400,000.
Texas
we're
at $340.
We're at $340, but East Texas, like Longview,
I think
MSA,
we're around like
we're much lower than that, $270, $280.
Well, see, we're at 200,000
compared to what, $340 was the national?
Compared to $340.
So
sheesh.
That's we're still very much an affordable area.
And that's just for August. Man, so with the, you know, all this, for one, the data is really changing. You know, we've definitely seen a decrease in median price, you know, sales, inventory is coming up, active listings are coming up, things like that. It at first I was getting a little hope. But, you know, I try not to, for one, I try to remember that, like you were saying, East Texas feels a little insulated, you know, from a lot of what's going on in the nation. A lot of people made a lot of predictions, things like that. The one thing that I've heard recently that does kind of concern me is the student loan repayments that are coming back around now. How do you see that affecting? Do you feel like that's gonna really drive down? It feels like the demand may dry up just because people may not be able to afford as much.
Yeah, I mean, it's a huge issue. And that's another thing, too, like with the inflation data. And I've been talking about that is, I can't remember the numbers now, but it's like $5 billion a month.
Whoa.
And student loan repayments. So that $5 billion of a month is going to be sucked out of the economy.
Sheesh.
And that starts in October. So we haven't even seen that yet. And that's what makes me like, okay, the Fed, if they're forward looking and they're looking at this, okay, they're taking current rent, they're taking current housing, backing out the old existing housing. They look at that $5 billion a month that's going to be owed in student loan payments that people were not paying, and they were putting into the economy, they were spending it. That's going to have a big impact. And I can't remember the study, the numbers of it on a survey, but it's like 80% of people said they were going to default on their student loans because they couldn't have. I mean, they haven't paid in two to 3 years. Yeah. That money went somewhere. Yeah. Like they're spending it out somewhere else. Now, will it impact the housing market? I don't think so, because we use, depending on the loan program, it's a different calculation. But if you're in deferred student loans, then you use either 1% if you're Fannie Mae, 0.5% if you're FHA or Freddie Mac, right?
Gotcha.
And then VA has their own calculation that they do, and it's even less. I mean, it's somewhere probably less than that, like 0.25% or so out of the VA calculation. But we already factored in a bigger payment than what they're actually going to have whenever it comes back in for repayment.
Gotcha.
So that's not going to affect the housing market as much, but yeah, it's going to impact people's budgets.
Gotcha.
And what they can afford.
Let's look at one more. I don't want to use up all your time. Let's look at one more. I want to get your thoughts on this one as well.
Right now, many people think the real estate market's going to be in trouble because high interest rates are making it more and more difficult for people to service their loans, and we're going to have a lot of defaults soon. What do you think about that observation?
Anything with a fixed income stream is worth less when rates rise. And it's an interesting situation because the rise in rates, usually real estate's the culprit. We often cause calamities in the economy. Banks get overzealous, lend 100% of cost. In this case, we really were an accidental consequence of the Fed's actions. We didn't really cause this problem. Banks hadn't over-levered, the loans weren't over-levered, they hadn't stretched loan to values. And the underlying fundamentals in most of the asset classes in real estate are okay right now in the United States. The apartment market, the industrial logistics market, the hotel markets, those are all in good shape. But there's no question that the Fed has reacted dramatically to try to slow the economy down quite late, obviously. And that has impacted real estate values. Yields on properties are moving up to reflect this higher interest rate. And the supply of credit to the industry is curtailed dramatically. So I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
Do you feel like we're in a Category 5 hurricane?
And what he's referring to is in the commercial real estate market, yes.
Yeah.
Yeah, and he said anything that's on a fixed income, whenever the rates rise, it causes the values to go down.
Sure.
And that is true because they're going to have to refinance the rate at a higher, when it adjusts, then it's going to do that. So,
man, give me really quickly. Give me your. I know you don't like to make predictions. Do you? How would you, if your family member came to you and said, "Hey, should I buy a house right now?" Yeah. What are you telling them?
If you plan on living it for 5 years and that's the goal right there, and like it's a better decision to buy.
Yeah.
Then the only time better to buy than yesterday was today, right?
Yeah, definitely.
And there was a statistic that I read the other day. People that bought a house between the age of like 24 to 34 compared to people who bought from 34 to 44, their median wealth was $72,000 more.
Wow.
Right? So, and now it doesn't fully even tell you, who would want $72,000 more in their pocket,
sure.
Right? So if the earlier you buy, the better.
Yeah.
And it's more than just $72,000 because that $72,000 compounds more throughout time.
Sure.
And so you're talking about could potentially be, hundreds of thousands,
sure.
millions,
yeah.
$1 million more because you bought earlier on than when you bought later.
Gotcha.
And Gen Zers, they have I think it's 50% of Gen Zers say they plan on buying a house, but at that age of 24 to 30, I think,
gotcha.
or something like that.
Gotcha.
And then millennials make up the largest demographic in the market. And the average age of home buyers is now like 37 years old, 36, 37 years old.
So,
and so that's prime millennial age right there where they're going to start entering and buying, getting in the market. And I think they're a lot later in the market because of student loans. A lot of them, like I know I was in college when the whole student loan debt crisis they were just giving money to anybody was going on. And, I had a lot of friends that took every single cent that they could get and did all that stuff.
Sure.
And, luckily for myself and my wife, when we graduated, whatever student loans we had was paid off very quickly, like 6 months or something like that. So there's, and we both worked our way through college.
Mm-hmm.
So we didn't, surprisingly, I did not fall to that. And then I bought my first house when I was 23 years old.
Nice.
And so, and then when I bought it, it was a 5-bedroom house, and I rented out all the other rooms, and I kept the master.
Nice.
And so they covered my rent for me. And
you really warehouse had.
And also
you want to be lazy that bad, huh?
I know. I wanted them to pay my mortgage. When I bought the house too, the government at the time was giving $8,000 to buy a house. So you can get up to $8,000, and it was.
I feel like something like that would be back.
It was a grant. They're already doing it to an extent. I'll explain that in a second. But so they gave me $8,000 to buy the house on top of it. So I was able to do that, and then I ended up selling that house a year later. And then what I did with that $8,000 too is I paid off my car. And so insurance on a 23-year-old male is high.
Mm-hmm.
So I could drop the full coverage on it. Went to liability, saved me another, which was basically saving about $200-300 a month or so, which covered even the utilities. So I did all that, and then we ended up once I got married, my wife and I, we bought a condo when we were in Michigan, and that we sold it a year later, and it doubled in value from when we bought it. So so we did that, and it just kept making. We bought homes. I bought homes in Indiana, Michigan, Louisiana, and Texas. So I bought homes in 4 states.
Wow.
So, it's all, and every time it's always turned out a positive.
Sure.
Whenever you buy. So.
Yeah.
And then what was the other question I was going to address with you? So I'll address it in a second, but I can't remember what it was.
I remember you saying I can't remember either.
Yeah. Anyways.
That's all right. Well, man. Again, I don't want to take up all your time today. I appreciate everything that you educated me on. Again, I know that I can always depend on you to call and say, "Hey, man, have you heard of this?" Like I'm waiting for the day where I call and like, "Hey, have you heard of this?" And you're like, "No, I don't know anything about that." I think I'm gonna feel accomplished, because you seem to have your hands on the pulse of anything economics, anything economical. And I appreciate it too, because I like to be around people that know more than I do, or have a better grasp. So as far as I also want to encourage anybody that's thinking about purchasing a home. I think it's still a great time to get in the game. Home values have continued to stay relatively high in comparison to where we were before the pandemic started. I think they're going to continue to stay there because people just still would. I mean, fortunately, at the same for the home buyers and homeowners, at the same time that home prices have gone up, so have rents. So it's like you don't really find an escape in either one. So if I'm going to do something, I might as well put the money to where it's something that I'm going to own eventually, and something that where I can maybe eventually, hey, if I make enough payments, then I won't have to make any more mortgage payments and things like that on it. So I think those factors, those small little factors like that, will keep home values high. I don't think we're going to see any plummet like some people are saying.
Yeah, there's not going to be a plummet, and the reason is because I mentioned the loan to value.
Mm-hmm.
The way you get the plummet is whenever people are doing distress sales.
Gotcha.
That's what causes plummets, because they're now, it's a fire sale, right?
Yeah.
They're just trying to get,
They're
short selling it, they're foreclosures, whatever the case is. And we're at record low default rates.
Yeah.
And so you're not going to have that happen. People are just, if you got equity, you're going to figure out a way to not lose it, right?
Sure.
So you're not going to have the distress sale situations. You also have a lot more demand than you do have supply. There's a lot of demand out there for people that want to still buy homes. And supply is going to be hindered to the fact that you have the lock-in effect.
Mm-hmm.
So because people have an interest rate at 2.5% to 3.5%,
not going anywhere.
They're not going to leave, because they can't get a better equivalent house for the same amount of money that they're paying, right?
Sure.
So they're going to stay where they are. And so therefore you're going to always have less supply entering. Now, when rates hit 5.9%, I think you're going to see the housing market have a pretty big surge, because you're going to unlock a good portion of people that they may be in the 5% interest rate. Yeah. They're going to be willing to sell.
Sure.
And then also you get to the 5.9. Interest rates are always relative. Like, the reason why, we feel 8% is high is because we were at 3.5%, 4%.
Right.
But then you take people that bought in the 80s,
exactly, and
right? And they were like, this is cheap, right? Yeah. And so it's always going to be relative. So what people are going to see that have been sitting in the market or waiting in the market, they're going to see rates at 5.9, and they're going to be like, oh wow, rates are good, so they're going to jump in, and then it's going to also help with making it where rent versus buy has a little bit more proportional benefit to the people buying.
Sure.
Right now, I mean, you really can't buy something for what you're paying in rent.
Right.
So it keeps a lot of people like, well, if I'm not gonna save money, because normally you could buy, especially when you do a 30-year mortgage, right? If you do a 30-year mortgage, you can buy and your payment is cheaper.
Right.
Because landlords, if they do like an investment property, typically in the commercial industry, they like to have 15-year mortgages.
Right.
So they're going to price their rent based on a 15-year. So if you went and bought a 15-year house, your payment would probably be around what you're paying in rent. But when you go to a 30-year, because you're extending that amortization out, you can buy and pay less per month than you do for renting. And right now you're not. It's probably about a 1-to-1. I don't know the numbers on it, but you're probably renting for the same amount of money if you were to buy it. But it will turn, and I think 5.9 will be one of the big points. And like the guy said, you don't want it to go from 5.9 to 4.9. You want to just like gradually just keep going down, and we'll get to a healthy market of where interest rates are somewhere between 4.5% to 5.5%.
Gotcha.
And that would be typically, I think, a healthy interest rate.
I hope we get back to that soon, and well, I guess a little bit later, not too soon.
Depends.
I am looking for, all of this roller coaster. I mean, it was great when it was high. It felt great for a little bit. It's like sugar, it felt great for a little while. Now that I'm having to, market myself again and market the houses and things like that I list or sell. It's kind of crazy to get back to it, but it's a good exercise. I feel probably more sorry for agents that came in during the pandemic and don't remember.
They don't know what it was.
They have
like
no
before.
experience, of, oh yeah, hey, I'm supposed to do this. This is how I get this house in front of more buyers. This is how I make the house, more appealing to buyers. We were just throwing anything on the market, it seemed like, and it was shooting out. So I am anxious to get back to a place of, of healthy balance, that stable market, that 4 or 5 months of inventory where we are, it's fair to all parties.
Yeah.
It's just a stable market. I hope we get there. I don't know. I'm less sure now than ever of where we're going to be, the next few months. When people were saying we talked last time about, Grant Cardone, talking about crashing and things like that. Now he's coming. Then he came back later on, y'all, and he was just like, oh yeah, there's no crash going on. There's no crash coming. And I just rolled my eyes, that he was doing the shock, treatment to get people to watch. I was confident, like, we're not about to crash. Now I'm like, I don't know what's coming.
Yeah.
I
know what's coming. It's just the question is when.
Yeah.
Right. You never know when that is. And then I'm talking to your point too. The tougher the market, the more creative you have to be. Mm-hmm. And so that's what you're going to have to do that stuff. And the ones that did come into the housing market during 2020, 2021, all that stuff. Yeah. They're the ones that got it the worst because they don't know what normal is. And then they base their lifestyle or based whatever it is off of that. And then you have that issue. And then even those that bought in that time period too, they're hurting because maybe you could afford, like, just because you can afford the mortgage on a $400,000 house, does that mean you should have a $400,000 house? Right. Because you can afford it. You can qualify for it. But a $400,000 house has more utility payments. They have bigger property tax.
I was just thinking.
They have more costly insurance. They got the repairs and maintenance that you have to do is much higher. Like
it's like when they used to do those home makeover shows, and then they would come in and make everything great, but then the cost to maintain that and all those things rose. And a lot of people that got those remodels also end up having to sell the home, or they would lose it because they couldn't keep up with what it took to actually afford that. Like you said, the property value rose on it immediately, and now you're paying more in taxes. If you had a mortgage, it's bringing your mortgage up, so all those things.
Watch the people, watch the homes that are coming on the inventory. A lot of them bought the house in 2020, 2021, 2022.
Mm-hmm.
They bought there because of that reason. They they bought too much house for what they could afford.
Yeah.
Because they could make the mortgage payment.
Sure.
And they're now with property taxes that just came out. You know, they're coming out. They're getting mailed out in October, but the preliminary values and all that stuff have already been coming out. So these people with property taxes are they're and especially whenever you buy, because the county, whenever there's a transfer of the deed, that's when they reassess the value. So they're going to look at, oh, we see the deed changed. We're going to go look on, Realtor.com, MLS. We're going to look on these different places. We're going to go pull your deed and see how much did you like, how much you borrowed on the house,
right.
how much you borrowed, what the MLS shows that it was listed and sold for, and they're going to reassess their deal, and so you can maybe have a property that, it's not nothing for your property taxes to double.
Sure.
Just because of the fact that they had the valuation here, now they moved it up here.
Well, and I thought there was and I need to look more into what all Greg Abbott, just pushed forward with property taxes. I know there was a decrease in, I don't know if there was the amount of taxes that.
Yeah, there's a cap, but it does not protect you for those that you bought within 2 years. Because homestead exemption is different.
Got it. Okay, and that kind of makes sense. I
so
can see that.
Yeah, so the next year they can jack you up as much as they want. They're going to bring it up to value as much as possible. That's why they do that, because it's not the reason why they wait for the transfer of the deed is because of the homestead laws.
Sure.
Because they are capped what they can do. So whenever that's been done, they know that, hey, I have this year to get the value right before you slap that homestead on there, and I can't raise your prices.
Yeah.
And that's why they do that. And so that's why in Texas you get a huge property tax increase the next year you buy it. And then also, not only do you have the issue with the property taxes, but you have the issue with homeowners insurance. Homeowners insurance is
it's getting.
I mean, I don't know what the numbers were, but I would typically assess a home at about, let's say it's a $200,000 home. I would average the homeowners insurance to be about $1,200 to $1,500 a year. Now, $2,000 minimum. If you're rural, if you're outside the city, you're outside the city limits, you're not close to fire department, all that kind of stuff, and different things. I mean, it's nothing for you to have a $2,500 to $3,000 homeowners insurance on a $200,000 house.
Wow. And for
I'm doing one right now in Lone Star, and it's $170,000 house. The cheapest insurance was $3,000 a year, and the person has great credit. There's no other. It's Lone Star. There's no fire department. There's distance from all different. The roof is even brand new on that one. So.
And for those that may not know, I mean, you're talking about two things that could, when we're talking about taxes and insurance, that should be factored into your monthly payment. If you're going to like Realtor.com, Zillow.com, and you're looking at those estimates and you're typing in your information, make sure you're also selecting to have the estimate of the taxes and insurance be factored into whatever they're calculating for their mortgage calculation, because what you see initially is just the mortgage payment, your principal and interest. You have to go in on most of the sites on Zillow and Realtor. You have to go and select, also give me the estimate with the taxes and insurance involved as well. $2,000 compared to, $2,400 compared to $1,200, that's an extra $100 on your mortgage payment that you're making every month in order to put into escrow to be able to pay those taxes next year. Was the lender doesn't want to take any chances with you paying your taxes. They could lose the house.
Yeah, they prefer to escrow.
Let's just go ahead and take care of all of it. Let's put a savings together for you basically in the escrow, and we'll pay it all. And also to your insurance, they want to protect your home is an investment for them too. They want to protect that investment with insurance. But if your insurance goes up, you're also going to be affecting your monthly payment every month as well in your mortgage. So these are things that that you should consider. These are things that you should shop around for as far as insurance wise, and you should go appeal. I think you should go appeal when tax time comes out and see if you can get your taxes lowered.
The problem is you don't have any leg to stand on. So the first year, I mean, even those calculators, they're very inaccurate.
Yeah,
So I would say, that's the importance of using a local lender.
I agree.
Because they're going to know how to pull the property taxes on and then before you even submit an offer. All my borrowers, I like them to get with me first on the property so I can pull the taxes. I can do a better understanding of what I think the property, and maybe even go ahead and order a homeowner's insurance quote so we can kind of get an idea. But even if you do those things and you say, yeah, this payment's fine for me, the next year, because I talked about with the county, they're going to reassess that value.
Sure.
And there could be a doubling of your taxes. Then, not only that, the homeowners insurance companies, they give you a teaser rate the first year because they want you to business, right?
Oh, they treat me just like DirecTV.
So they have a little discount that they give you for, home early shopping or home buyer, whatever they give you. Well, because they want to attract you because that's when you're at it.
Sure.
And then the hope is that
you won't even pay attention.
That you won't, inertia will hold and you won't ever go do that.
Wow.
And then what's also happening right now is a lot of insurance companies that you're going to find out are pulling out of Texas because of all the hail damage. I mean, hail damage is just unreal.
It was crazy.
And so they're pulling out, a lot of them pulling out of Texas, and then a lot of them are going to go to where right now the standard is about a 1% wind hail deductible. And so you got to pay 1% if you file a wind hail deductible claim. They're going to probably move that up to 2%.
Sheesh.
And now if you have a $400,000 house and you got to pay 2% deductible, I mean, you're talking about $8,000. Now, who has that? Who has that sitting around?
I mean, that's a lot.
I mean, do people have $8,000?
Especially if you just bought the house, you exhausted a lot of your capital to get into the home. Now
not only that, now you got to pay the $8,000. Now you filed an insurance claim. Now your premium's going to go up.
Sure.
So
and y'all, this is not to discourage you from buying a house. This is to take in the factor. Hey, how much should I purchase? Because it is just bigger. It is bigger than your mortgage payment. You have a lot more life to live than just paying your mortgage. After you pay your mortgage, and of course, you got about 1% that you can.
Electric rates.
Electric rates. You got about 1% in maintenance of your purchase price. You got about 1% every year that you'll be putting towards just basic maintenance for the home. And then also too, you got to account for things that you have going in your own life. You're saving for retirement. For college funds and things like that. There's a lot of different things going on. So yes, can you quote unquote afford $400,000? Yes, depending on who is the beholder.
Yeah.
And you and this is why I always, when I go through, I have a first 5 steps for buying your first home. One of them is, hey, what is your monthly budget that allows you to also attain your other goals as well? Not just purchasing the house, because it's sexy to purchase a house. You take your pictures, have people over, housewarming, then everybody leaves, and they leave the bill all up to you, and also to making everything else happen in your life. So I don't want you to ever overextend yourself. I want you to buy a house. It should be a great journey. I hope you find something that you'll love. You may have to adjust what it is you're looking for. Kind of at the same time, in my opinion. That way you also are able to achieve more goals. You can build up equity in the house. That $400,000 house may need to come maybe 5 or 6 years from now. After you have even more capital, more equity, you're able to attain some other goals financially. Maybe you get an increase in income or something like that from a job promotion or something like that. All those things I think you should take into consideration. And I like to be an accountability partner for people as well. Hey, let's really look at this, and see what where your head is. See if I can help you with that. So
you want it to be a blessing, not a curse. And you want to know what you're getting into and be prepared so you can budget for those things. And that way, it is you're not house poor.
Sure.
And you're able to enjoy the house because. I mean, what good is it if you have the house, but yet you can't live in it, right? Because it's too expensive to live in it, right? So think about those kind of things. Keep those in your mind. And then a lot of things, there's a lot of things we don't look at. that you have bills that we only look at what your
Right,
current liabilities
right.
are. Like the one guy mentioned, $400,000 if you have no other debt. Well, what if you do have to get a car and you have to get a car loan? Well,
Yep.
now you're going to be overextended.
Right.
So even that, with what his proposal, is dangerous, because unless you have a way to prevent you from having to ever take on any other debt, so you better have very much strong, adequate reserves in that situation to keep that in mind. Or if you got to pay for daycare, or if you're, if you have to pay for health insurance. I don't like if people's health insurance is expensive.
Yeah, it is.
That is not calculated in our debt to income. We're not asking you how much your health insurance bill is, and so that could be $500-$600 a month, easy on that I'm not counting you against. So you got to know your own budget, and you have to know that you need to have some margin of safety in your next payment, because the next 2 years is when your mortgage payment is going to change the most.
Gotcha.
Your mortgage payment will change for 3 reasons: property taxes went up, homeowners insurance, or there's an escrow shortage.
Oh, okay. Yeah. And then you have to an escrow shortage is how much the escrow is. I call the escrow like a savings account that the lender puts aside so that they can pay your taxes and insurance for the year.
Correct.
And so sometimes if they're estimating how much you need to put into escrow. And of course, if they go off the current year's taxes, what you're saying is when the new value comes in to the appraiser and that's higher than what you originally planned for, what the lender originally planned for, it's going to cause the amount that they put aside or put in escrow to be short of what you actually need to pay it.
Correct.
And then the lender pays it, and then all of a sudden they need to get theirs back by adding to the amount that you're going to pay every month.
Correct. So the property taxes here in Texas are retroactive, right? So they're you're paying in the arrears, I should say. Their taxes are in the arrears.
Gotcha. Okay.
So whenever you buy the house, you're not paying this year's taxes. You're paying last year's, right?
Gotcha.
So especially like right now, let's say you just closed in September. September is kind of the worst position on an escrow basis, okay? Because we use the latest tax certificates to qualify for the house, okay? So we're using right now, you bought in September, you closed in September, we're using 2022 property taxes to qualify, okay? Whatever the tax cert is on the 2022. 2023, October, the new values come out. Well, when you qualified and when we set up the escrow account, when we made the payments, we base it on 2022, not 2023. But now, when taxes are due in December, right, well, we pay earlier in in October, when they're due, by the time they do the escrow analysis, you typically in March or February, depending on the company, when they do that escrow analysis, you've had even less time to put more money into the escrow account.
Wow.
So you're going to be behind.
Yeah.
And so that's not only did your taxes go up, but now you have to make up the shortage. You can pay it immediately, pay it up front if you want to, but typically most people will pay it out over 12 months.
Sure.
And so now not only is your payment going up because your taxes went up, but now you're going up because you got to make up that escrow shortage.
Yeah.
So you're getting double hit that first year.
So these things, again, y'all, it may seem a little daunting, like, oh man, why should I do this? Here's what I found out and how I literally run my business. Most people can make a good decision with good information. If you have the correct information, you can factor things in. If you want to buy a house and you've gotten yourself to the place where you can qualify, you've probably got some responsibility in you. You got some sense of responsibility. And if you take more good information like this, like you just received, and factor that in, you can make a better decision for yourself. You may not be able to get the $400,000 house right now. You may have to delay that gratification, and then, just take a little more time to get to the destination. We're gonna be buying and selling houses to the end of time, y'all. We're gonna be buying this. People are always gonna need a place to live, and so if hey, we may need to wait a little while. That dream may need to come true a little bit later. So, John, I don't want to, like I said, I don't want to use up all your time.
Yeah.
I greatly appreciate you stopping by again, man. For I think you were on season 2. Now that we're on season 4. And of course, I always want to keep coming, having you on, because again, you just bring a wealth of knowledge and information that I think people can use, and also too, man, the service that you're, that you are applying to the community as a city councilman. I appreciate you. District 4.
Yes.
District 4. This is considered District 4.
This would be District 4.
District 4. Yeah. So
well,
man,
actually, maybe a little further south. I don't know if it cuts off at Yates. I gotta pull it up. But
Yeah.
usually east of Judson, north of 80.
Oh,
But there's a carve out around here, so I think this may
Gotcha.
be different district. But
Got you. Well, I know that I'm in your district, man. And I just appreciate you taking that on that task. It is something to have to speak for the people. And I'm sure that carries a weight, man. And I appreciate it. I think you're a great man to do it.
I appreciate it. Thank
Yeah,
you.
man.
Thank you for having me on. Always.
Yeah, always. All right, buddy. Hey, I will have John's information posted. It will appear on this video, and also too, you can find it in the description of this video. John, if you're thinking about buying a house, I encourage everybody apply, get started. Let John talk you through it. If you can get qualified now, great. If you can't, great. We're going to get great information either way, and be able to create a plan for you. Yep. Thank you so much, everyone, for checking out this video. I hope you all will subscribe, like, and share, and we'll catch you on the next episode.
Bye, y'all.
All right. Thank you.
Awesome.
All right. Hey, man. Oh, man, I'm sorry that.
No, you're good.
That